we were going to see some sort of insolvency phase, the overhang from this whole situation. That didn't happen because of the unprecedented amount of monetary printing that went on and the ongoing fiscal stimuluses. So then we look back and we realize that the worst recession in all recorded history only lasted 2 months. And that was all about, again, this stimulus. So if you are Janet Yellen and Jay Powell, you sit in a room together and go, that was pretty good, eh? It kind of worked. It worked for the financial crisis, and now it worked for the entire world closing down. Maybe we don't have to have a business cycle. Maybe we don't have to have risk anymore. So the marginal propensity for them to fire that gun again is extremely high. Well, the market sells off. Well, let's just add some stimulus. We're still not sure that equality is quite right. We'll add some stimulus. Every answer becomes we can add stimulus. So the market currently has been looking for strong growth, and Jay Powell was out today talking about potentially tapering because the growth numbers have been strong. But my work suggests that the economy is actually weakening. So China has a weak credit cycle and its GDP growth is falling sharply. Japan has got itself in a huge mess now with the COVID Delta variant. That's the third largest economy in the world. And, Europe still stop-start. The US still not fully recovered. And it's normal. Normally it takes maybe 2 years to fully recover from a recession. And this was a big one. So after we call the end of a recession, generally the central bank cuts twice again after it because growth isn't fully stabilized. So we're in this phase where growth, I think, is starting to weaken. We see it in things like, the most dramatic being the University of Michigan sentiment surveys for buying climates of houses and cars and big ticket items. People have just gone, this is the worst buying climate we've ever seen. It's the worst numbers we've ever seen in these surveys because of the price rises that came from the supply shocks beforehand. We see rollover in ISM and these other business cycle surveys. So we're going into a period where the Fed are talking about tapering. The market really thinks inflation is the big enemy, and probably we're about to see a slowdown. Now, knowing that every single recession since 1962, the Fed cut rates twice after it, and we saw this little spike in bond yields first, and then bond yields went back to the all-time low almost every time since 1990 for sure. So the probability is for me that the economy's weakening, the Fed cut again twice. There's probably more fiscal stimulus to come, and the markets haven't priced this in at all. Now, in the context of what does that do for asset prices? Well, I've talked a lot about the significance of this printing. It doesn't come up in CPI, the inflation that everybody talks about. It comes in the fall of the value of fiat currency, the denominator. And we see that because basically you can divide any asset by the Fed balance sheet and everything's about flat. And you can do the same with German property and the ECB balance sheet, or UK property and the Bank of England balance sheet, or Swedish property. It works pretty much consistently. We're lowering the value of fiat currency overall. So if the Fed are going to do that, we should see a rise in the value of equities, the value of real estate, most assets, and especially cryptocurrency.